My name is Leighton Roberts. I'm one of the co-founders of Sharesies. I also work in the operations and opportunities area, so that's sort of keeping that the ship sort of going, making sure everyone's money makes into wallets, and then being out there helping to find some great investments to make available as well. So Sharesies is here to create the most financially empowered generation. And the way we're focusing on doing that to start with is by giving someone with $5 the same investment opportunities as someone with $500,000. So for a bit of where Sharesies has come from, we started a little bit over 2 years ago, and initially started by offering some ETFs, that's exchange traded funds, so much like any other investment fund, but it trades on an exchange. And then pretty shortly after, we added some managed funds as well. We've built an experience to make investing as easy as possible and to give lots of confidence, and what we thought was really missing in the world of investing. And our app enables you to track how your investments are going and watch you grow your portfolio payday by payday. One of the great things about investments is, Sharesies is how we've broken down some of those barriers that used to exist. So we really are meeting that $500,000 and $500,000 vision, because you can literally invest with just a cent on Sharesies, and you can start building your portfolio into some things that were previously sort of locked out for people looking at those numbers. So what's been happening, we've been really, really busy lately, and I'm sure for those of you who know about Sharesies, you're probably familiar with some of the changes that has happened, but we've now grown to, that's a pretty cool number, to 55,555, and that number has probably changed since we last did it. It's growing really fast at the moment. In fact, in the last few days, for the first time, our sort of moving average that we track has moved to growing by over 200 investors a day. So that's something we're really, really excited about. Those investors currently have $73,595,654, a pretty big number worth of investments, and that's all money that we think may not have been invested if Sharesies hadn't been around. So we're stoked that everyone's getting involved in something that we think's a really awesome thing to be doing. Another cool thing about this number is it took us about 12 weeks, I think, to get to the first $1 million invested through Sharesies, and now we pretty much grow by $1 million every day. It's pretty fitting that we're in this building today, the NZX, and thank you very much, the NZX, for letting us use this space. But one thing that happened in the last couple of weeks is we were welcomed by the NZX as a new market participant. And what that means is Sharesies is now able to trade directly on the stock exchange. So as part of that, we've opened up all the companies on the main board of the stock exchange, and we're really proud when we got to have that pink on the ticker, and it changed the view, or the idea, I suppose, of what an investor looks like in New Zealand. So when you log into Sharesies now, for those of you who have recently, you have two options. So you still have your funds option, and our investors still love funds, and funds are a great option, but they just have a few more now. So we've added the rest of the exchange traded funds that were available that we previously didn't have. In addition to that, like I said earlier, we've added over 130 companies, and some of them are companies that you'll be very familiar with, and some of them you might not have heard before. But we're seeing some incredible traction and enthusiasm into investing those since we launched them. I think only maybe 2 weeks ago. It feels like a long time, but only a couple of weeks. And another one of the exciting things is, previously, investing in companies, it has been very expensive, even just on a per trade basis, and we've built it in a way that it's still possible to invest 1 cent. And prior to us launching, I think the minimum fee per trade was $15 in New Zealand. That was for trades less than $1,000. The minimum fee to buy or sell a company on Sharesies is 0.00005 of a cent. And of course, we still have our the funds available and stuff that don't have any brokerage. We've been lucky, or I guess you make your own luck, but we've been working really hard towards a few awards lately as well. So one of the ones that we're very proud of is we're a finalist for the Diversity Awards, and we're a finalist in the work-life balance category. And just last week we were announced as part of the Wellington Gold Awards as the Cyber Gold winner. So that's some incredible companies that were up as finalists in that category, and it was a big surprise for us to win, and we're very humbled to win that. The other thing that keeps growing is the team that's working on Sharesies. So I'd invite you to keep an eye out for people in Sharesies t-shirts. We're reasonably noticeable, either with the pink or the pineapple, and have a chat to them. So the team's now 29 people. We're currently hiring another customer support person, and we're always looking at ways we can grow the team to make sure that we can keep delivering amazing experiences for all our investors. A bit for what's coming up next. So the first thing is we want all Kiwis to know that they can have access to investing. So that means we want to keep growing that number I said of 200 investors a day. We want that to keep going up, and we want more and more people talking about investing and you know, places that they can put their money to make sure that it's working harder for them, and in places where that were probably reserved for the wealthy previously. We're working our way out of beta again. So 2 weeks ago when we launched the companies, we have launched that as a beta. It was initially just a private, so a bit of an invite-only release, and then we've released it to obviously all of the Sharesies investors now, but we're taking feedback at the moment, and we're getting some amazing feedback through, and we're working those and developing the product out and making sure that's as good as it can be. We're exploring how we can give more confidence to investors. So now that we have more access to investments, then an obvious question is, well, which ones should I be investing in? So a few months ago, we were given a robo-advice exemption. That's the ability to offer personalised advice, which was under the current licensing is not possible without the use of a natural person, so without a human. So we're looking at how we can use that exemption to make sure everyone's confident making great decisions. We're also trying to help motivate people to invest. So we just want people making sure they, you know, as part of that confidence, that this is a great place to be spending their money, and watching that grow for the future, and feeling really, really motivated to keep growing those portfolios. And we're also beginning to explore more investments to add to Sharesies. So as part of the feedback, we always get lots about what people are looking for as well. And we're always interested in the types of things that people feel like they'd like access to and currently feel a bit left out of. So we will do a bit of a question and answer thing at the end if anyone wants to ask any questions about what's happening at Sharesies or what's coming up. But before I ramble on too much more, I am going to introduce our amazing panel. We're extremely lucky today to have Linda Clark as the facilitator for our panel. Linda will probably be a familiar face to many of you here. She is now a partner at Kensington Swan, and I'd like to welcome Linda to the stage, and she's going to introduce the rest of the panel to you as well.
Hopefully this, yep, we're all hooked up. Welcome, thank you very much for that, Leighton. I'll ask the panellists to come up, and I'll introduce you once we're all in place and sitting down. So the purpose of this part of this evening's event, we'll have a conversation for about an hour, but we want it to be a conversation rather than a lecture. So there's a couple of ground rules, and I'll talk about those in a moment, but let me introduce the panel. So in no particular order, let me start with Bernard Hickey, actually. Bernard, welcome. Bernard is Managing Editor of Newsroom Pro, which is a terrific online news service. Bernard is one of those very rare broadcasters and journalists in New Zealand who makes finance and particularly the stock exchange comprehensible for people who don't really understand it. So he's one of the reasons he's on the panel, and one of the reasons I wanted to introduce him first is that the purpose of this conversation is to talk in English rather than in jargon. That's why I've been invited, because I couldn't understand the jargon if you paid me, and they're not paying me. But some of this stuff is really complicated. Well, it sounds really complicated. It's actually not complicated, but it sounds really complicated. And one of the great things about what Sharesies is trying to do, which is sort of unlocking that complication and allowing all of us to be active investors, a lot of that also depends on us kind of feeling that we understand the language and we understand what it is that people are saying. That's quite hard in this area. So Bernard is one of our translators, and welcome. Mark Peterson. Mark is the CEO of NZX. That's where we are here, so thank you very much for hosting us. Mark's job is to build up New Zealand's capital markets, to bring New Zealand companies to their NZX, and to help New Zealand companies get ahead. So that just takes the morning, and then he does nothing in the afternoon.
I can make it complicated though.
He can make it complicated, but he's not going to. So it's great to have you as part of the panel, Mark. Phillippa Harford at the end. Phillippa is CEO of Infratil. CFO.
Marco would be really well.
He would. Yeah. Shall we just do a quick move now? He'll never. Yeah, whatever. He's been there a long time. Infratil, for those of you that don't know, is a Wellington-based company listed on NZX. It's a company that owns really cool infrastructure stuff, like airports and electricity generators and retailers. And today, very exciting, its acquisition of Vodafone was finally confirmed and has gone through and is a done deal. Congratulations.
Thanks.
And last but not least, Brooke Roberts is CEO of Sharesies. And I don't need to tell you any more about Sharesies because that's all been done, which is lovely. And Brooke is absolutely committed to talking in a really simple way about these things. So that's really why she's here. So the rules for this conversation are pretty straightforward. There are no rules, except that if you've got something really pressing that you want to ask and that you want to contribute to the conversation, I'm all for it. I might not see you, it's a little bit murky at the back, so just put up your hand and in a very polite and engaging way, just say hey, and I'll take your question and we'll put it to the panel. And that's the only rule we have. So let's get started. The purpose of this conversation is to talk about investing in New Zealand, and I guess the first question, and this is the only question I'll get all of you to answer, because the rest of it we'll just talk to each other, but from starting perhaps with you, Brooke, and going down the panel, why invest in New Zealand?
Cool. So why invest in New Zealand and New Zealand companies?
Yeah.
Yeah. So, well, the great thing is now you can on Sharesies, but essentially the reason why we really wanted to do that is to really unlock those opportunities that someone with 500,000 typically had. And why investing in New Zealand companies is so important is we're all part of New Zealand, and being able to back companies in New Zealand, help them grow, help them create jobs, have an impact on the community is really important. And also having your voice where you want to make change or what you really believe in. I love a recent story I heard of one of the Sharesies investors is going tramping soon, and they were like, I need to go buy some tramping gear. I'm going to go to Kathmandu because I own shares. And I love the conversations that this is going to be able to have in New Zealand and really breaking down that taboo around money, but also helping us really consciously consume a lot more too and really think about our money and the impact it can really have. And I think that's what's really, really important, that we start in our own backyard too and have access to New Zealand companies and help them grow.
Great. Bernard.
I'm a little bit more ruthless about it. We need to invest in New Zealand companies because we haven't invested much in New Zealand companies over the years. We've tended to invest a lot more in housing. We also have a lot of money invested for us overseas by the New Zealand Super Fund and our KiwiSaver funds. And actually New Zealand companies need a lot of investment to grow, particularly the younger ones. And this is the reason I'm here tonight, because I'm a huge admirer of startups like Sharesies, and I remember a conversation with the people at Sharesies a few years ago across the road in one of those fun startup places where everyone has a desk in the same place. and drinks the same coffee. Hopefully not from the same grounds. Yeah. And so I think for New Zealand to really grow and to be more productive and to have more control over its future, then New Zealanders have to invest in our own companies. And the stock market could do with a bit of help because, in my view, the settings we have in our economy don't give it enough help, and the scrum of the investing landscape has been screwed too much for too long into housing. And anything that people can do to diversify into New Zealand shares, bizarrely, is a good thing.
Thanks. Mark?
Yeah, on a similar vein to both, excuse me, really. There's the emotional aspect. We love New Zealand. We want to see New Zealand grow. We want full employment in New Zealand. We want the country to survive for our children and their children. So there's all that emotional stuff, but if you get to the economic argument, companies are the foundation for growth, and they are the value creators, if you like, across our GDP, really. And they need investment. And if, with investment comes more product, and with more product, becomes more opportunities to employ people. And that is actually good for society. So, on one hand, you've got the emotional aspect. On the other hand, you've got the economic side. And I guess from a very selfish perspective, the exchange sits in the middle and tries to facilitate the investor piece and the company piece. And we need to be bigger ourselves. So I'd pick up both threads really, economics and the societal factor.
Yeah, sure. I think probably people have largely covered in terms of the way Infratil works. We certainly are, clearly a New Zealand company, been around a long time, value our shareholders and are looking to derive value for shareholders. So we are strongly supportive of investment in New Zealand companies for obvious reasons. I think the one thing I'd also note though is we've got to make rational investments for our shareholders, and as a consequence of such, of that driver, we're not always only going to invest in New Zealand investments. So, you'll see it was great today to announce the Vodafone acquisition in New Zealand. More recently, before that, we've actually looked in other markets as well. So we're a strong New Zealand company, but we're actually open to where it is that we direct our capital, because ultimately we want to derive, good returns for our shareholders.
We'd love to see that Vodafone come back onto the NZX.
I can't guarantee that.
Some interesting observations there, and let's just unpick some of those before we sort of move on to another theme. But and Bernard, this is a point that you raised. I mean, New Zealanders have traditionally put their money into bricks and mortar. That is most New Zealanders' principal and often only asset. So why is it, do you think, that that's been so attractive, and something like shares or investing in a company has been either not as attractive or simply not on the radar at all?
There's 3 or 4 reasons. One is there's a natural tax advantage to investing in property, particularly leveraged property, where you're borrowing a lot of money to do it. The tax-free status on that capital gain is a real thing that New Zealanders who own property have fought long and hard for, and voted long and hard for, and will continue to do so. And will continue winning while a lot of younger renters don't vote. Secondly, we're also aware that over the last 30 years, a collection of factors have meant that we've not built enough houses, but at the same time we've welcomed in a lot more people than we've got for the houses. And we now have a housing shortage of, depending on how you measure it, 100,000 or 500,000, say some. So it's like a doomsday machine, really, where all of the factors are lined up to push property prices higher. And if you've got leveraged exposure to that property price rise, and you know that you've got never-ending rises in demand from lots of new people coming in and falling interest rates, then it seems like the perfect thing. And for those people who've bet time and again that prices will keep going up, they've won time and again. And even now, Treasury, for example, is forecasting house prices go up another 20% from here, and that they'll be 40% higher than when the government got in 2017 by then.
And so, Mark, in a way, going to your comment, that has been the formula for growth, hasn't it? Rather than seeing companies as the generators of growth, which is what you were talking about.
Well, certainly, from an investor perspective, obviously the housing element looks attractive, with a bunch of the reasons that Bernard suggested. I think the other thing is, over the years, the NZX hasn't probably, or the market hasn't probably, sung the praises of the returns that the share market actually has delivered. And, on a like-for-like basis, in other words, if you take the leverage element out of it, equity returns for the top 50 companies in New Zealand have actually outperformed even the Auckland housing market. And hardly anybody knows that. So, there is work for us to do to make sure that people do understand the return profile of our market. And not only against housing, but the NZX 50 has actually outperformed the major indices around the world. So if you think the ASX, you think Asian markets, US markets, and even European markets, the NZX market is incredibly strong. For lots of reasons, good companies and a few other factors. But I think that awareness of what's possible, we're starting to shed a bit of light on that now. And Sharesies are doing a great job of expanding it to an audience which has probably not really had much exposure to it before.
It's also worth looking at the relative values of New Zealand stock market to the housing market and the size of GDP. The New Zealand housing market is now worth $1.1 trillion. The stock market, last I looked, was about 70, $80 billion.
That would include fixed income, but
yep. And so the relative value of the New Zealand housing market relative to GDP is close to 5 or 6 times. It would be 7 or 8 times the value of the stock market. In other countries with properly valued assets, that relationship is more like equal. So the housing market is the same as GDP and the same as the stock market. So if you looked at it from a valuation point of view, you'd say that New Zealand housing is wildly overvalued and New Zealand stock market is wildly undervalued, and they need to be somewhere closer together. So that's another way to look at it.
Do you want to break down GDP?
So total income for everyone in the economy in a year. And so that's currently around about $300 billion. So what we're saying here is that our housing market is worth 4 or 5 times our GDP. And actually in other countries, that number is more like 1 or 2 times GDP.
I want to come back to one of the things that you mentioned, Brooke, because a lot of this conversation to date, and we'll come back to this point, but a lot of this conversation is about what's the return on to the investor. But the vision that you described at the beginning is much broader and bigger than that, isn't it?
Yeah, definitely. I think there's so many benefits that is being talked here in terms from a societal point of view, and also helping increase the economic value that we can create. But yeah, it's so exciting to see the individual changes that we can create too, in terms of us all feeling like we can be financially empowered and feeling like we can be part of the system that we've felt locked out of, and then being able to have those conversations and break down all these barriers that we all feel around having access to this world. I think when we started Sharesies, we found that there were 3 key reasons why people weren't investing. And that was they felt priced out. You needed tens of thousands, if not hundreds of thousands, just to get started. And with the previous kind of brokerage fees, as later mentioned, that kind of was what could work economically. You needed quite a bit of money. And then if it wasn't, if you had that, you also felt jargoned out. Like, this industry is just full of all of this, all of these acronyms and all of this language that makes you feel like, oh, I don't know enough about this. I'm not knowledgeable enough, so therefore I can't. And also, it's felt like a bit of a black box. If you had that money, you kind of gave it away a fund manager or something to kind of deal with, and you didn't really know what was going on. And so bringing that transparency into the market and helping people really understand how to invest is really important. And then the fourth one is, or the third key barrier we saw was that people were really left out. Financial institutions really focus on wealth management. So if you've got money, they're like, oh, hey, I'm here to help you. And you can get access to wealth advisors if you've got, say, $500,000 or more, or private bankers if you've in the millions. But outside of that, there's this real gap in terms of wealth development, like helping people actually get access and build their wealth over time. And so I think all of those factors that we really care about here at Sharesies, and that we're starting to see change. Like even today, we had $1 million go onto the stock exchange. Like the power that we're going to be able to bring to the to New Zealand companies and to the exchange through retail investors, so that's us, compared to where a lot of the money comes from is institutional and big corporates. It's really exciting to see that our voice and our money can be working harder for us and harder for New Zealand businesses and our economy.
Well, let's talk about the voice, because that's a really interesting idea, actually. So, and maybe Phillippa, you might be able to help us with a kind of 101, a beginner's guide on this. But what is the role of the investor in the company?
Yeah, sure. I think, as a start, as a company looking at an investor, you've got to make it quite clear what your reason for being is. So I think an investor, needs to be able to relate to what you're saying, what the company's trying to do. So, as a good example, we talk about investing wisely in ideas that matter. So we've got a very strong focus on renewable energy, data, obviously other forms of infrastructure. So the role of the investor is to provide capital. You've got to be able to distinguish between equity investors and debt investors, because clearly they do different things. They have different access to getting their money back.
So explain the difference for our audience.
Yeah, so using us as an example, we've got actually three primary forms of capital for Infratil. We've got clearly our shareholders. In our market, the value of our equity today was about just over $3 billion. We've also got listed bonds, so those are like a shareholder, but they hold a bond, and that means they get a defined amount of interest, and in the most cases they basically have a maturity date when they are going to get their money back. So that's a bond holder. And our third source of capital is banks. So we've got banking relationships with relatively large banks. They, we basically borrow money from them, and we use that capital to invest in the businesses that we own, or in the case of the transaction we did today, we use that capital to make significant acquisitions like Vodafone. So the equity part of that is always going to be a very important part in terms of when you're making those decisions. You're going to say, how much of our capital do we want to get from equity holders? How much can we manage from a debt perspective? And how are we going to manage the competing demands of both of those interest groups to say that we can satisfy the bondholders or the banks about what sort of return they want, and that we can also satisfy the shareholders in terms of what return they expect for the risk that they are taking and investing in us.
And how much say does a shareholder have in the direction you take? Sorry.
Yeah, I think, certainly we've got a very open dialogue with our shareholders. So we have a lot of communication that goes out. We're always interested to get questions from shareholders about what we're doing, why we're doing it. We've certainly received a lot of feedback about what people think about our acquisition of Vodafone, and we get input about renewable energy, because clearly saving the planet is an important thing for a lot of people. So they do get input into that. That doesn't mean that necessarily we're going to agree with everything that an investor has to say. We will look to make the best decisions on behalf of shareholders and take advice where we can, but certainly we have a very open dialogue with our investors.
Anyone else on the panel got an observation or a comment on that question of how much say you can actually have if you're investing in a company?
I think it's unusual now actually for a lot of fund managers to be actively involved in a company, putting up motions at annual meetings and getting really involved. And actually there's something slightly strange developing in the global system for listed capital where a lot of the money is put in by what they call passive investors or tracker funds. And I've always wondered at the end of the day, if everyone puts their money into passive funds and all of these companies are owned by passive funds, who's actually keeping an eye on the managers? And at some point, someone's going to be able to make some money from being an active investor. And as a journalist, I'm always keen on people causing a ruckus, because that's more fun than not. And I often wish that New Zealand fund managers caused much more of a ruckus publicly in keeping executives honest. Now, a lot of stuff happens behind closed doors in board meetings and phone calls to chairs and independent directors, which is all good. And one of the great things about a publicly listed company is that it does have to be open and transparent about how it does things. One of the trends we're seeing globally is that, and this is not just in New Zealand but all around the world, you're seeing a lot more assets which used to be in publicly traded markets being taken off market into privately held vehicles by private equity and other investors, often debt funded. And then there's virtually no transparency for the public, be it for customers or shareholders, customers or workers and or the wider public. And so that's the other sort of good thing about a stock market, apart from as a place to invest and make money, is that it provides an element of transparency, public information for a wider set of, stakeholders is the horrible word, but it means the general public to see. Whereas when companies go off market, they become black boxes that we don't know much about.
Looking at this audience, I mean, a lot of you are a certain age. Really what I mean by that is under a certain age. And Brooke, maybe this is something that you can comment on, but when I've been to a shareholders meeting, don't take this the wrong way, but they don't look like you. They tend to be older, actually a lot older. And isn't that one of the inevitable tensions of if you're going to put money into a company and you want to have some say over the direction of that company, but a whole lot of those shareholders in the company are 70 years old plus, you've got completely different timelines you're working to. You might have a completely different direction that you would be interested in to those kind of shareholders. How do you think that works in real life?
Yeah, I think there's a real momentum shift there, and that's what we're quite excited about with opening up Sharesies. I mean, right now the majority of shareholders in New Zealand are over 60 or live in Auckland or male, and I think what's really exciting about Sharesies is 80% of our customers are under 40 years old. We've got 50-50 gender engagement, and we're starting to help this generation really get access, or more generations actually get access. It kind of feeds off what's being kind of discussed here, but internationally you're starting to see a lot more shareholder activism where people are really, especially it's really seen in this kind of generation, that they really have a strong emphasis on companies having really strong environmental practices, that they're doing good for the world, that they've got good governance and processes in place, so they've got a board structure and management that really care beyond just financials. They care about their impact on the environment, on the employees, on their customers and community. You're starting to see that these factors are really starting to be at the front and centre of a lot of management team discussions, and also starting to change that conversation with shareholders. And I think if you take out the age difference and really focus on what we really care about as a society, I guess, and making sure that businesses are a force for good, and we're starting to see the activism happening internationally. It'll be really interesting to see, and that we get more voice in New Zealand around making sure that we are investing in companies that really are doing good for Aotearoa and our people, in the world.
I'm curious about how many people on Sharesies are actually actively trading or investing. I'm sure you've got a few people who are set and forget, what they call dollar cost averaging, just chunking money in week after week. But how many are actually getting involved and, buying and selling and, thinking about it and talking to each other and that sort of thing?
Yeah, I think before for NZ companies being on our platform, we still take that long-term approach, right? We still think that you should build your portfolio one day at a time with amounts you can afford. But what I think we're seeing with NZ companies, like it's only been 2 weeks, right? So the data is still new, but growing exponentially. Like we've got thousands of trades going through every day. 1 million today. It's growing and growing, and I think once we start seeing more momentum there, then that opens up the opportunities for these kind of conversations to really take place. Once there's a bit more momentum, I think. But yeah, I think. The active trading is interesting because it's not about, it's about when you're first investing in a company, like really putting behind, really thinking about, when you, like, look, I'm not going to lie, I'm definitely having a little try with some companies, putting $5 here and there, but then there's some that I'm like, actually, we don't want to put my main money, and I'm really researching, I'm looking into them a bit more. And I think that's what, but I don't expect to sell because I've really cared about looking, anytime soon. Because I'm really looking at, I believe in the long-term value that company is going to create in New Zealand.
Well, I'll come back to the earlier question about questions like sustainability and so forth. But you've just raised an issue which takes us down a different path, which I want to grab while we're here. And what you just described, to be honest, that sounds like a lot of hard work to me. I mean, I think one of the things that I reflect on why I haven't been an investor in shares is I'm really busy. I've got shitloads to do. And I haven't got time to be an expert on this business or that business or another business down the road. So how much do you have to know to invest?
I think we on Sharesies in particular, we really tried to break down what are the key things people need to know and show that so that people have the price history, but information about the company and can kind of get a feel for what that company is about, and so that so far from the research we've shown, the research we're starting to get has been enough for now. But what we see is access is just one part of what we want to do. We really want to create confident and motivated investors. So the next phase of what we're looking at now is how can we incorporate research and advice into that. So we could maybe say like that this investment really suits your personal style of investing, or provide a bit more research there. For what I think, for when I'm thinking about investing maybe a bit more in individual companies, I personally look for a bit more is, do they have an integrated report? So that's every pretty much company that's listed will have on their website an investor centre, and that's where you're talking about, we say Infratil, all their announcements will be in the annual report. And I'm really looking at, an annual report is just financials, so that just shows that company is like showing their financials and it's all audited. What I'm really liking is integrated reports, where that really shows beyond financials what else, what is the impact they're having on the natural resources in New Zealand, on their people, how are they really treating their people, and you really get an insight into what it's like to be part of that company and they're looking at all of their stakeholders, not just shareholders. And I think that I'm really excited about where that's going as more companies get on that bandwagon and start sharing those insights.
So that, Phillippa, sounds like a lot more hard work on your end of the transaction.
Yeah. It's actually, though, I think most companies recognise that in order to give the best value to shareholders, they have to take all stakeholders into account. So it's almost like it's a byline, and in a good way, though. I mean, because it's almost a given that if you don't look after your community, don't look after your customers, don't look after your environment, then clearly that's going to have an impact on the way that your company behaves and performs. So I think that actually, when I think about community involvement, having ownership of local assets, having the impact on, the investment decisions you're making and what they do to the local society more broadly. I mean, we also have a really significant amount of input required at a regulatory level, and I think that's another thing that you never want to sort of understate about what's involved when a company's trying to, go down a particular pathway. So even if you took it a little bit wider than that, clearly one of your big stakeholders in an area like infrastructure is going to be government, whether it's local government, whether it's national government. So to me, it's actually probably stuff that a lot of people were doing anyway. It's just that you have to be much, much better at communicating what you're doing, why you're doing it, and setting out a pathway for investors so that they can understand what your investment rationale is and give them confidence that you've had regard to, you know, those stakeholders. So I think previously it was probably implicit. You know, people would go through and think, you know, what is this going to do to A, B, C, except that you have to be much better at communicating that now, because people will say, well, have you thought about that?
So you are actually seeing people asking different questions and behaving
Absolutely.
differently.
Yep.
And Mark, you're nodding your head. You tell us your view on that.
Yeah, no, the exchange plays a really important role here, and it creates a platform, if you like, for want of a better word, which has a whole lot of minimum standards for companies to meet. And they might be how often you report, they might be the meetings that are offered up to shareholders. It also provides a whole lot of, or it suggests a whole lot of guidance around, you know, the ESG reporting, you know, the environmental, social and governance side of things, and what's good practice. So it provides companies lots of guidance around that so that they can actually, you know, broaden out and then tell all of their investors, not just the larger ones, but certainly all of the retail investors as well, you know, how they're going in that regard. And what it also does, and it sort of comes a bit back to the point you made a little earlier, Linda, where it encourages communication with investors. And again, you don't distinguish between large and small. So for example, the NZX is a listed entity itself, and we put out monthly metrics, if you like, on all the key attributes of our business, so that anybody could go to the nzx.com website or any issuer's website and actually, you know, if they do that, and actually see the performance of the business each month. And that actually then allows an informed decision, you know, for those that are sort of tuned into what that all means, an informed decision on progress. Because generally also what you do is we publish a strategy, and you publish for everybody to read your direction, what you're intending to achieve, you know, and how you're going to go against that. So a public company has all of that obligation, which is actually very good practice. And even if you're a private company, it's probably some of the stuff you should be thinking about anyway. But the exchange actually sets that bar, that minimum bar for companies to perform at. And I think that's, you know, from my point of view, you know, when you're thinking about investment in individual companies, those are the sort of things a retail investor should really be looking at as well, if you have time. If you don't have time, then, you know, some of those fund products, which actually give you a whole lot of diversification, but you could choose an equity exposure, or you could choose a fixed income security exposure, or you could choose New Zealand or Australian exposure. They give you actually a very good balance or a return, if you like, off a general exposure rather than trying to pick stocks.
So just explain that a little bit more. Like, and if you're new to this, what is it you're actually describing there?
So what you've got is, for the fund product or the exchange traded fund product, and even funds that aren't on the exchange, they will invest in certain type of investments. So for example, I pick one exchange traded fund where you could put $5 or $10, whatever it turns out, and you could pick the NZX 50, and a portion of that money gets invested in all those 50 companies. You don't need to pick the stocks, but you effectively get the return of the 50. Similarly, you could pick the return of a bond fund, you know, which might invest in investment grade or close to investment grade bonds or fixed income securities, and get the return of those. So you actually get the return of the amalgam. You don't get the return of the individual debt security or the individual equity.
And can I just interrupt you there? So if you look at the returns on those kind of funds as opposed to individual shares, is the data available that says to your new investor, some give generally a better return than individual shares, or you can't? Can you do that?
You've got a wide range of returns, but all the information is there for, you know, to see. And as I said before, you know, people will be able to track the share price of the individual securities, and you can probably do that on Sharesies. You can certainly do it on the NZX website. You can probably do it on Infratil's website. But at the same time too, if you invest in those fund products, you can also track the performance of those funds as well. So all that same information is there if those products are listed.
Yeah, exactly. So that like on Sharesies, we've got that price graph, and you can see how the price has grown from 5 years to 1 month in the last month. But and you can see the dividend that typically is paid out if there is a dividend paid out, and then once you've invested, what that gain is looking like for you.
Bernard, do you think it's as easy as they say?
It is much harder to invest in individual stocks, and you're right. If you're being really honest with yourself, you will know that you're up against professional investors who have analysis from a range of investment banks and other research houses that they can use. They have all sorts of fancy tools. They pay thousands of dollars a month for their Bloomberg terminals or their Reuters terminals or whatever it is. And so it is really hard to beat those people who are professional traders and investors. However, you can get exposure to these types of investments in a really easy way by buying into an exchange traded fund. And where Sharesies has made it easy is to reduce a lot of the transaction costs and the friction, I suppose, in getting into those sorts of investments. You still have to make the call on, you know, whether you want to be exposed to New Zealand stocks 100%, or whether you maybe spread your money around New Zealand stocks, Australian stocks, global bonds, global property, whatever it is that you can find the exchange traded fund, and you could come up with your own pick and mix, you know. Maybe that's an idea for your next section, is a pick and mix box. And then you have to make a call, because essentially if you were making a call that I'm going to put all my money into New Zealand stocks, you are saying, I think it'll do better than everything else. Or you're making a call about your appetite for risk. And you know, it'll depend on your situation, how old you are, how much money you've got, how risky you feel, or how much risk you like. Yeah.
I think traditionally it has been an or, right? Like you've had to have heaps of money to get in, so it's like, well, you're really going to have to focus on your strategy early on. And what we wanted with Sharesies is people to really feel like they can have it all. You know, you can have a growing investment portfolio and your smashed avocado, you know, like you can, on our platform, that's why the minimum 1 cent is really important, is we want to remove that fear, and just like, you can learn by doing. You can just give it a go. You can own all of the NZX for less than $2. And I think that's really important in terms of removing that fear, giving it a go, seeing what works. Diversification is really important, and we have that communicated right throughout. That's why we did start with New Zealand funds too. Obviously it was a little bit easier for us to kick off with, but also to make sure that knowing that we were attracting people who might be investing for the first time, that they could, you know, have, say, the New Zealand top 50, but also have global, so the US 500 fund, or you know, emerging markets and all these other funds that we offer. So that's why we offer a mix, and we'll continue to build out more of a mix too.
Let's turn this around and look at it from the other perspective for a moment. Phillippa, tell us, how does a company get listed? What do you have to do? What do you have to show? How hard is it?
Well, I think it goes back to you know, Mark's comments around the rigour that's involved in actually being an NZX listed company. I can't say I was there when Infratil actually listed 25 years ago, and I would imagine that the rules have probably changed quite a lot since then. But I think I would certainly endorse what Mark's saying around the governance, the rigour that a listed company has to apply. Whether it's talking about the way in which it reports its financial outcomes, when it talks about the way in which it manages its investment processes. I think from my perspective, I see all of those processes as enablers. I don't see them as you know, door stoppers or impediments. And the reason for that is you've got to go through the process of appreciating that actually, you know, the way you have to have an independent directors, a board of directors, accountability to your shareholders, that is all intended to make sure that when you're making the decisions, you make the best possible decisions that you can. And that's certainly the way that I look to approach that, in that having those processes through being an NZX listed company means that whilst we're not always going to be right, because let's face it, no one can always be right, you can try to put yourself in a place where you make the best decision you can with the best information that's available to you at the time, and that as much as possible you have regard to what you think the risks are, and that you make it clear about what those risks are to the people who are making decisions about the money. So I think there's probably two parts to that. Sometimes, for example, you don't necessarily have to go to the market to get money to make an investment. You might already have capital on your balance sheet to do it. So in that case, you've just got to keep testing yourself to say, I'm a listed company, what kind of information do I need to let my shareholders and my bondholders know about the investment that we're making? And so it's all about communication and transparency. And I think that's exactly, as Mark said, that's what being a listed company is all about. I think there's an element of that, people need to also, though, understand that there's things like confidentiality, and I think that is a part to touch on. And what I mean by that is there'll be certain parts or certain points in a process whereby actually information is confidential information. So shareholders and the market don't get to know everything instantaneously. There's certain processes you'll go through where confidentiality can be retained, and shareholders need to kind of appreciate that. I think that's probably one, I suppose a hard line that we manage to make sure that we know when we've got information that we need to disclose, and certainly we will do that, versus when we're still working on something which is an incomplete transaction and we're allowed to keep holding that tight to ourselves, because otherwise, that can have very adverse consequences.
Now, one of the things about the New Zealand Stock Exchange, and Bernard mentioned this at the beginning, I think, is that it's got a relatively small number of companies on it, and it's hard to get companies to list. So I'm going to ask Mark about this, but Phillippa, I wanted your perspective first. What's your view on why it either isn't attractive to New Zealand companies, or it's too hard, or what are the blocks or the blockages that stop New Zealand companies listing?
Well, Mark's going to have a better view of this than me, but I suppose to some extent it's got to have a function of critical mass, as in how large do you need to be in order to need to open up that line of capital, and secondly to be able to sustain. I mean, there's different forms of listings, right? There's the main board and there's off the main board. So Mark's probably better able to do that than I, but certainly there is a lot of, I don't mean a lot, but as I said, it's all about governance, rigor, making good decisions and being transparent. You've actually also got to be prepared to take that leap, right? You've got to have a management team, and the business has got to be at a point where they're prepared to be accountable to a wider group of people. Now, you'll have fledgling companies, and they'll have founders, and not unlike Sharesies, businesses grow in that kind of an environment, and at one point they decide, well, okay, do we want to take this bigger? And even that decision in of itself, right, to go and say, we're going to take this company and we're no longer going to be accountable to this group of, say, 5, we're going to open ourselves up to have more shareholders, even that can be a big leap for some people.
So, Brooke.
Exactly.
So, from your point of view, when does it make sense to list on the stock exchange? Or do you just wait to be bought out by Google or something?
So our plan from day one is to IPO. That's what we've always said. But
IPO.
Yes, good point. Yes, it is. Ooh, which means to list on the stock exchange. But what we know is that opportunities come up as you go on too. So it's about making sure that we're always making the right decision for Sharesies at that time, and that's what we'll continue to do. Yeah. But yeah, you need quite a lot of rigor behind you. You need 2 or 3 years of audited accounts. Like there's a bit of a process to go through. We'll get a product disclosure statement together, so a bit of a profile. So I think that there's definitely a bar. You need to be worth at least $10 million. Like there's a lot. The barrier is actually not too high, but it's a substantial one. And yeah, we're tracking towards that.
Mark, what's your view on why so few?
It comes back to the point that Phillippa's making. It's about companies that want to take themselves into different world, and they can go to the public markets for a couple of reasons. One is they might want to access capital in the future to grow, and they want to tap, I guess, the public to help provide that capital. Another reason to go public is they might see the public markets as a way to transition away from their current ownership structure. So quite a few large family-owned businesses, for example, are out there. You know, a family or a family trust, you know, may own the majority of the shares, and they're thinking about succession. And how do you preserve the business? How do you give the business a sort of a shot in the arm, but at the same time take a step back, but want to see it carry on? You know, so the public markets is a good mechanism for that to occur. But if you go through what the public markets is all about, scale does come into it, because you've got to have those minimum levels. So you've got to have a board structure which has got the right amount of independence on it. You've got to have the financial accounts which have got the certain amount of, you know, prior audited materials, and all of that's designed so that an investor can read it and have trust in what's there. You know, you then come back to, you know, getting the business organised to be able to operate in a continuous disclosure environment. And as Phillippa said, you know, you're doing things where you've got to keep informing your investors, because the market's got to be treated fairly, albeit that there's a point at which that occurs. So you've got to have your business ready for that. And when you see businesses in New Zealand who have, you know, started small, borrowed from the bank, borrowed from friends and family, you know, growing up, might have half a dozen shareholders, you're a long way, I guess, from having that rigour that I guess a public market would require, except that, you know, a lot of ambition is out there at the moment, and a lot of people are interested in growing their businesses, you know, into that domain. And we're seeing more and more, you know, a lot of pipeline coming through where we're talking to companies that said, look, we're interested, but we might be a year or two away, and that's fine, because we'll walk with them through that process and help them through that process alongside their other advisory groups. So we actually see the future as being pretty bright in terms of what's coming. Our business has changed quite a lot, just in terms of the way we're set up and the way we connect with our customers. And we call it our issuers, you know, our customers, our brokers are our customers. You know, so we've got to work with both those different customer groups and grow both sides of that in order to get the scale that Bernard was talking about before that other markets have.
The thing about scale, though, if you talk about the size of companies, I mean, at the other end of the scale, you've got the Xeros and the Trade Me's who've taken themselves off the stock exchange. Yeah. So what kind of impact does that have?
Well, certainly it's not desirable, you know, from my point of view. We'd love to see them stay. You know, personally, I actually think Xero didn't really have a need to go. They were actually going absolutely gangbusters here in New Zealand, and they were listed in Australia anyway, and have continued to perform very, very strongly. Trade Me was a different story in the sense that, you know, somebody came along and said, you know, we think we can do more with this business, and we're going to write you a big cheque. And it's very, very hard to sort of stop that occurring, you know, because investors can do that, you know, to the public companies. They've got to come out and they've got to be fair to all shareholders, and they've got to put the offer on the table, and if shareholders or a certain percentage of them accept it, then, you know, the job's done in a way. So, you know, disappointing from the public market's point of view, but at the same time too, that's just markets working as well. So you can't expect it not to happen. The question for us is, how do we make sure that as New Zealand grows, we actually grow the market, that proportion of market cap or market capitalisation, total market capitalisation to the GDP of the economy. We're sitting at about 55% at the moment. The ASX, the US markets, European markets, they'd probably be north of 100% of GDP. So we know there's a long way to go. Some of that is structural in the sense that we're a young economy, a lot of ag or agricultural driven businesses, a lot of cooperatively owned businesses, and they're not necessarily suited to the public market. So there's a big proportion of the economy which would find it hard to be publicly listed. But nevertheless, you know, as these businesses grow and as the economy matures and as savings levels grow generally, you know, KiwiSaver or, you know, Sharesies for want of a better description, and the other brokers out there, you know, we are getting much better at saving. And then we've got to deploy that savings in order to help the economy grow. So I think all of those factors together, you know, paint a pretty positive light for us, I think.
Let's talk about investment trends, or what, if any, changes you all think that we're seeing in the way New Zealanders invest. Anyone got a off the block observation?
I think one of the things people are thinking about right now is why central banks around the world are having to cut interest rates aggressively and start to print money, and also how that money is going to be deployed around the world once it is printed, or it's still being printed in Japan and Europe, and will soon be printed again in America, I'd expect. And at the moment, a lot of that money is being printed and being used to buy bonds. So a third of the world's junk bonds are now trading with negative interest rates, which is a thing. And that's helping to push up the value of all assets, including stocks. And so a lot of people are thinking, where does this all end, or does it just keep going? Because there's no limit to how much money you can print. And that's a thing that is good for some people. For example, Trade Me was essentially bought off the market with freshly printed British money, and a lot of investment is going into assets with debt, which is real cheap right now, but at some point it may not be. And I think that's one of the things people are thinking about. Now, that means, for example, asset prices, and typically stocks, particularly ones that are producing cash and dividends, the value of them goes up in an environment like that and seems to never fall. And that will be the thing that people have to think about.
I think that goes back to Brooke's point that you're never going to have a crystal ball to know what might play out. You also can take and I don't disagree with that. All I'm saying is, as an investor, you don't want to be absolutely frozen in the headlights and say, well, like, there's so many things to decide about. I think there were some things around things like thematics. You know, you can learn about what a particular industry is. You can learn about what that company's saying about where they say their strategy is going to be. I think if you can also take a long-term view, you talk about your diversity, because I think if you think about all of these things so hard, we'd all be a bit scared, really. So I think there needs to be some, if we talk about what Sharesies can do in terms of people being able to invest, you know, smaller amounts of money and have a diverse exposure through doing so, and actually learn, you know, make some really valuable learnings about what they think about particular companies, what those companies are contributing to the economy, how those companies are, you know, creating jobs. You know, I think there was hopefully an element of that should make it much more accessible for people. And so to go to your question about what investors are asking, you'd like to think that if you can put in smaller amounts of money so that your amounts at risk in relation to a particular investment aren't, you know, you're not going to completely ruin your retirement if things go wrong, then that should encourage more people to participate.
There's some questions come through from Facebook, from people watching the live stream, and some of these go kind of follow on nicely from the points you've been making, Phillippa. So this is a question from Emily. And she says, what are your thoughts on divestment, e.g. fossil fuels? Wouldn't it be more effective to remain a stakeholder of these companies and demand change?
So my perspective on that, I mean, my perspective is that you should put your money where you see positive, where you want to have it, where your individual beliefs, behaviours and kind of goals orientated. I know that there are some groups that do that, but you typically, in order to really create change, you need a whole group or a body coming together to make that happen. And there are some in the States and New Zealand. We've got a shareholders association who may be able to help with that if they all believe that that's kind of where they want to vote. But you'd need to like pull together in order to really make that change, and I'm quite a substantial part of the company.
Anyone else want to comment?
The only thing I would say there is investing is a choice, and you make that choice, you know, for the outcome that you're shooting for. And if you think you're going to be successful at lobbying a company, or you have enough weight in your shareholding to lobby a company effectively to get that outcome you're looking for, then that makes there's some logical sense in that. If it's sort of a hopeless cause in a way, then you might want to think about that choice a wee bit. because the other way to actually give a signal to the company is to not invest. And by a large group of people not investing, that actually speaks quite strongly to the point as well. So there's different ways to tackle that question.
There's a number of questions actually have come through on this issue of ethical investments, and obviously that's important to people, or to a number of people. So one of the questions for you, Brooke, is how does Sharesies manage that level of information for investors?
In terms of ethical yeah. So right at the moment, so if you've got funds, you can filter them by if it will say ESG, which means that they rank high on environmental, social and governance factors. And we've got a bunch of responsible funds there. On individual companies, at the moment you can see it in their description. In the description on the company, it will typically say something there. And as I said, we're going to build out more on that research and advice, and that's why we're in beta at the moment. We're trying to get feedback we are getting feedback from investors, and any here, please do share or watching, because all of that feedback will help us design and build that aspect of our platform out even more.
This sort of brings us to this sort of wider issue of a sort of social issue, social responsibility, and you kind of touched on it, Brooke, right at the very beginning of this conversation. Do you think that it's actually possible to get, to sort of hit that sweet spot, if you like, where you're getting really good returns, but you're also putting your money, or the companies that you're investing in are able to give those returns to the investors, but also make good environmental, sustainable decisions about how they do their business?
Definitely. Yeah, I don't think that I don't think it's profit or purpose. I think it's purpose. You can be a purpose-driven and a profit-driven company, and I think we're seeing more and more change there. Recently, Sharesies became a B Corp, which means that we became a certified, we went through this rigorous process and were verified, and a certified B Corp, which means that by this, it's run out of this not-for-profit from the States, which has built a community of around 3,000 companies around the world now who are verified to be a force for good. And as part of the companies in there, I say Patagonia and Allbirds, and I think these are companies that are profit-driven, but they put their purpose before that. And I think the future is you can't cut corners to make profits anymore. You need to, and as you were talking about, that transparency is really, really important to investors and growing. And I think more, and we're already seeing it in some companies in New Zealand already, but the more that we can see the total impact a company can have, the more that the capital they'll get, as we're seeing more and more investors really caring about that, and the more profitable I think that we'll start seeing those.
So some of the academic research is showing that companies that have a higher level of diversity management ranks, those that focus more on longer term effects of their investment on the environment and their staff and their customers, do better in terms of profits and creating value than companies that go for the short-term bottom line effect. And the New Zealand Superannuation Fund, which you could argue is the biggest, hairiest, best resourced investor in New Zealand, spends a lot of time talking about and thinking about and analysing companies on those sorts of things. And some of the research, particularly around fossil fuels investing, and even things like tobacco and firearms, shows that you can, as long as you pick the good companies, you can do better than if you even pick the good companies that do bad things.
You're nodding your head, Phillippa.
Yeah, because I was just thinking though, one of the interesting things from my perspective is obviously we've got a relatively significant investment into data centres. Data centres do use a lot of power. So people need to be, most people love their mobile phones, they love having data. I think we also need to acknowledge that, you could have a data centre, just as an example, couldn't just rely on solar power, right? So that's never going to cut it, because you can't have a data centre that has to operate 24 hours a day, 365 days a year, and then expect that it can somehow rely on an intermittent source of power. So I think the conundrum, I completely agree with where people have to do that. All I'm saying is that the tricky part is that there's some convenient, well not convenient, but it's easy to overlook like what is involved in providing data and the challenges that are involved in providing like a completely green, I would imagine a completely green source of energy for a data centre. So there will be some limitations that are actually just now technological limitations. That doesn't mean that the companies involved in those sectors don't want to do as much as they can, but fundamentally there will be natural constraints as to what can be achieved and over what time frame it can be achieved.
I think, yeah, there's a spectrum sometimes when it comes to ethical investing on where you're at, but you know, that's one that it could all be run on solar power, but like steps towards that could be carbon offsetting, and you know, like there's things that you can be doing, and just I think being really transparent about that, that you know, this is an issue and these are the things that we're doing to try and improve it.
And as an investor, I think people just have to decide, you know, where they want to set their line, because some investors might say, well, actually, carbon offsetting's not good enough for me. I really only want to invest in something that's completely directly green, and that's completely, you know, up to an investor to make that choice. And that goes to Mark's point. Sometimes, you know, it's not as much about necessarily how much you can change a particular sector, because there'll be natural constraints in that in any event, but making your own decision about, in light of what your values and your priorities are, what shares you want to hold.
And that comes back to the point you made a little earlier, doesn't it? Which, if you're an investor, for us, if we're making those decisions, we need really good information from the companies, but we need really good regulation to ensure that you're held to the standards that you say you're going to live by.
Yeah.
One last question, because we're going to hand back over to Leighton, but this is from another Facebooker. Well, actually there's two, because they're kind of straightforward, I think. So this is for you, Brooke. Quite a few people are asking, is Sharesies going to provide access to IPOs or international companies?
We're exploring. Like as Leighton said, we want to give someone with $5 the same investment opportunity as someone with 500,000. So there's a lot in that, and so we're always looking at how we can add more investment opportunities to our platform.
And a nice question to end on, actually, because you know, the whole purpose of this conversation is to sort of get people talking and demystify it and make it easier. This question is, how can you engage younger New Zealanders, and they're particularly interested in that 13 to 20-year-olds?
Oh, cool. So what we're doing in that space is we launched kids accounts nearly a year ago, I think, August last year, I think. And that's where people from 0 to 16 can have a Sharesies account. And that's been really helpful. We've got over 3,000 kids now using Sharesies with their adult relationship, which is fantastic to help them learn by doing, get access, have those conversations. I'm hearing stories of families that compare their portfolios at the dinner table. Like, that's really exciting to get them engaged. That, you know, I know somebody who also, they are a netball ref and they get their money and they give it, and if any money they get and they put into Sharesies, their parents match, and so they're putting in too much for their parents to match, because they're just loving that, I guess, that ability to see that grow. But yeah, I think for us, we do a lot around this is really important. The blogs that we're doing in terms of just trying to demystify as much of the content, show what it's like to be a first-time investor. All of that, really, we're trying to get as much content out there just to help anybody just know a bit more about investing. And then there's other great platforms out there in that, especially in that younger age from 13, like Banker, who are out there in schools trying to improve financial literacy. And I think when we all come together, we're really helping empower this generation.
Really cool.
What about KiwiSaver?
KiwiSaver, yes. So that's really important for if it's their first job. Not their first job. If you're working, you should have KiwiSaver essentially, because you're getting matched returns. Like where do you really get that? It's kind of like that parent netball referee conversation I was having before. But KiwiSaver is really, really important. I think what we know is that there's still a lot of there's a lack of awareness of what KiwiSaver really is. Some people think it's a savings account at Kiwibank. There's so much myths around KiwiSaver that we really need to break. I think Leighton kind of puts it, maybe it's in the name, saver, where it's really about investing. We did heaps of research at the start, and a lot of people felt like, we asked them, were you an investor? And majority would say no, and then we asked, would you have KiwiSaver? And everybody's hands goes up. It's like, well, you are an investor. So I think that there's a lot in terms of that perception that needs to change too around what actually is KiwiSaver and that you're already investing.
Sadly, though, KiwiSaver has become a place to save your housing deposit.
Yep. One place, yeah.
Well, one change at a time. Hey, it's been really fantastic having this conversation, and I'd like you all to thank Phillippa, Mark, Bernard and Brooke. And we're now handing it back to Leighton.
Yeah, thank you so much, everyone. It was such a great discussion, and I took a whole lot out of it. I'm sure everyone did here, but there's been a few questions that have been asked from the people on the live stream, but just before we wrap up and say thank you to these fine people, is there anyone here who has any questions either to any of the panellists about any of the conversations that were raised or for Sharesies? Yes, could you just come up and... Yeah, I know, but we've only got one handheld mic, so... Now you'll be the last person to say yes, but...
Okay, oh dear. I'm a little curious, selfishly, about the graphs that keep going up, because I bounce into the app and I like to play, and they're all going up. And I remember reading a book that said buy low, sell high, and they just don't go down. So, at what point, or what would you expect? Because I keep hearing about a possible recession coming and a little bit of a break. Would you expect that us new educated folk would now start buying, or are you expecting quite a dip in behaviour? And I'm looking at Brooke, but obviously anybody can answer. Or Leighton, sorry. Was that eloquent enough?
I mean, maybe Bernard or Mark or...
So whatever I say does not constitute financial advice.
Kensington Swan.
Yeah.
There is no financial advice here.
No. And you're right, it's a fantastic point to make. The lines always go up, and there's a whole bunch of people in this room. So who here was younger than 10 years ago? So that means who here's, yeah. So 10 years ago we had the global financial crisis. There are people now running companies and making investment decisions and running banks and making loans who've never experienced the global financial crisis and who think that things always go up. And actually, sometimes they do go up for longer than you think. And actually, what seems like a bubble now may actually still be just a bigger bubble later on. You just never quite know. And one of the things that's bizarre at the moment, actually, is that when you hear news about impending recession or a slowdown in the economy, everyone goes now, oh, that's good. Well, that'll be a cut in interest rates then. And what happens when you cut interest rates? Well, that means it's cheaper to get debt and cheaper to use that debt to buy an asset to push up the asset price. And we're all richer, even though the economy looks weaker. And you do wonder, when some sort of law of financial gravity takes effect. But actually, there is no limit to how much money that central banks can print when you have an extremely low inflation environment like we have now. And you'd have to be a brave person to bet against the power of those central banks to yet again rescue markets that are now actually in many cases too big to fail. And we actually have one in New Zealand, which is the property market. It's too big to fail, i.e. central banks and governments won't let it fail. That's a slightly, again, not financial advice.
The only other thing I would add to that is think very carefully about your time frame, and think very carefully about your own personal circumstances and what you may or may not want that money for. If you're saving for if you're a younger person saving for your deposit on a house, then you'd obviously make a prudent decision on the back of that, because you don't want to lose it. If you're saving for the longer term and you're 20 years old and you're going to get it out when you're 65, that's quite a different decision, because you can ride out cycles over that length of time. So I think the it's not an answer to a question, but maybe it's just a few points to contemplate: is your risk profile, your time horizon, and then just invest accordingly.
There's not much I can add to that, except for a lot of people seem to have forgot January and February this year, where we saw some of the most volatile markets that the world has ever seen, and the key difference there was how quick the recovery was. So, and maybe we would have been talking about it a little different if that hadn't happened. But you know, people are experiencing up and downs. That's what markets do, albeit we're in a very prolonged sort of upward cycle.
There is one story I should tell about market volatility, which is an awful lot of fun. So I'm old, and in 2008, this is September, October 2008, when the world appeared to be ending and global banks were 48 hours away from collapse and all sorts of things, I went to a press conference where the chief executive of the New Zealand Superannuation Fund stood up and said to all these journalists and people here, all of us taxpayers, that he was going to use $10 billion of our money and go out into the markets and buy with his ears pinned back. He talked about having a supermarket trolley that he was going to push into the great supermarket, investment supermarket of the world, and hoover it up when everyone else was running out of the supermarket with their hair on fire. And we all thought, wow, that guy's mad. That guy's so mad. That guy was Adrian Orr. And he proceeded to do exactly what he said, which was to buy everything that moved when everyone else was selling. And now the super fund has an incredible investment return over a long term. And luckily for us, it's one of those funds which does have an incredibly long time horizon, as Mark pointed out, and has done well out of it. So one thing that's worth watching is watching those people who run in the other direction when everyone runs out of the movie theatre that's on fire. They're the ones to watch. Now, by the way, he's the governor of the Reserve Bank and can cut interest rates whenever he wants, and we'll do that next Wednesday at 2 o'clock in the afternoon, by the way.
Is that your prediction?
Yeah.
Now that I've scared people by making them come up here, but is there any other questions? Could you, sorry.
Kia ora. I'm just wondering if you, this is for Sharesies in particular, if you guys are thinking of doing something like, I guess what I'm interested in is investing in a kind of incubator stage. So for a company at its early stage, something, you know, with values that I believed in. So something kind of like a pledge me or give a little bit in a company investment sense.
I can answer that. I mean, $5 and $500,000, like we say, that's the sort of the goal for what we want to open up investment-wise, and it's all going to be about the demand and stuff that we hear from our customers about what we want to do. But yeah, early stage investing is very exciting. It's certainly a world that people have been locked out of with a lot of money, and crowdfunding and stuff is helping. But I definitely think one day that might be something we might want to tackle.
What you need is this new venture capital fund that the super fund is creating to list on the stock exchange. Also, it'd be fun to see the New Zealand Super Fund list a tracker fund on the stock exchange that we could all invest in.
Back in your court there then.
Yeah, we'd really like that. Any other questions? No? Well, as I mentioned earlier, there's lots of people with Sharesies t-shirts around, so if you do have any questions and just didn't want to come up here in front of the bright lights, and they are bright, then feel free to grab anyone in one of these shirts, and I'd love to have the conversation. I'm sure our panellists will be sticking around for a little bit afterwards as well. Just before we wrap up, I've just got a few gifts here, so give me a couple of seconds. Well, Brooke, you get one as well.
Thank you very much.
And I don't have my t-shirt because I haven't done my washing.
Wow, on mobile phone it looks like chocolate.
and Linda. Hey, look, on behalf of Sharesies, we honestly feel so honoured that you've all taken the time to come and speak with us and all of our investors. I think this is just another one of those things that in their vision they've sort of harped on about a few times, which is this $5 and $500,000 and those same opportunities. And for a long time, people with $500,000 have had the opportunity to speak with people like you and hear some of the great conversation that we've had today. And we're really happy now that we can bring that out a bit wider. And the conversation was fantastic, some amazing themes. And just on behalf of everyone here, if we could just put our hands together and thank the panel for coming today. Well, that's it for the next round of Share Chat. Thank you for everyone who for Share Club. Sorry, thank you for everyone who joined us on the live stream as well. Thanks for everyone for coming out in this horrific weather. Stick around, have a drink. If there's any pizza left, it'll be cold now, but everyone likes cold pizza. Some of the drinks, and yeah, see you next time. Cheers.